Coming up on Launch Stories.
If you ask any venture capitalist out there, would you invest into a great team that has a shitty product or is in a market that you just don't believe in? Nobody would do that. You have to have the package, right? And that's the same thing. The Beatles are the Beatles because they have a couple of things going for them. They're not only a great band, but they also write great music and they know how to perform. So, there's a lot of things.
Welcome to Launch Stories, the global startup podcast. I'm your host, Zoltan Vardy. The Launch Stories podcast gives you a taste of what it takes to launch a global startup. Listen to founders share their personal ups and downs, their professional wins and losses, and the lessons they've learned along the way to building an international company. You'll also hear from accelerators and investors that support entrepreneurs along their journey around the world and what they think is the recipe for startup success. So join me on Launch Stories, get inspired, and learn the ingredients of a successful global business. My guest today is Michael Schuster. Michael is the co-founder and partner at Speedinvest, one of Europe's most active early-stage venture capital firms with over 600 million euros of assets under management. Speedinvest's portfolio of 230 companies includes 4 unicorns, Bitpanda, GoStudent, Tier Mobility, and WeFox, and has established the firm as a go-to investor in the global fintech space, with offices in 5 cities across Europe and 1 in San Francisco. I'll be talking to Michael about how his decade-long experience in the IT industry shaped his role as a startup investor and why he thinks venture capital firms like Speedinvest can make a positive dent in the universe. So let's listen to Michael's launch story. Hi, Michael. Thanks for being here with us.
Hey, Zoltan. Great to be here. Thanks for having me.
Absolutely. So I've heard so much about Speedinvest over the years. So I'm really excited to learn about the history of the company and your experience as one of the co-founders of this venture capital firm. But prior to founding Speedinvest, you worked in the IT industry. Is that correct? For about 10 years?
Yes.
And you completed a degree in computer science. You started the first commercial blog hosting platform in Europe. You worked with Semantic Technologies, for those of us who don't know, that's helping machines understand data for media companies and social media monitoring and so on. So all of this just tells me one thing. You're basically a product guy.
Absolutely.
You're focused on products. So here's the challenge. So I'm a sales and marketing guy, and you're a product guy. As we know, sales and product people don't necessarily always agree. So I thought we could kick off our conversation today with a real product guy versus sales guy face-off. And since you're the guest, I want to give you the chance to first convince me why product is more important than sales in building a successful startup.
I can see you're not wasting time to get to the core questions here. No, it's an interesting one. You're absolutely right. I am a product guy. That's also sort of the reputation that I have within Speedinvest. And I just do think while over the past decade, we probably have seen a couple of companies built on top of especially marketing. Facebook and other platforms have made it so easy to market software. They're all coming around now eventually, and coming back to product-led growth, to acknowledging that, you can probably spend a lot of VC money on marketing your stuff. But if the product doesn't hold up, if you're not sort of, if your customers don't love it, if they don't stick around, if they don't talk about it, if they don't expand their offerings, you're just going to waste a lot of money in trying to convince people to use your product. So while I do, of course, I'm a realist here. You need to have good sales marketing, and the best product is nothing without good sales. In the end, for me, it comes down to a lot of the miles, especially as a startup, you can do in the early stages, even more you can do by having a great product and being obsessed with solving something for your clients.
But isn't the startup cemetery littered with companies that had a great product, great solution for an important problem, but just weren't able to get customers to pay for that solution?
I think that's the interesting part of the whole, having a great product or building a great product. It doesn't yield, so the input and output relation is much more difficult than it is with sales and marketing, right? You spend an amount of dollars for a salesperson, or you invested in the marketing, and you can track the success and you immediately get feedback, which makes it easy, but is also it might be not true for you down the road, and you're not seeing the whole consequence of it. With product, it's much more difficult. You're investing into product that doesn't pay off immediately. Sometimes your product is just too early. Sometimes the feature that you built is just not right, just not quite right. You need this extra 10% to really make it well, or the market needs to understand it. So it's a much more difficult relationship, and that's why I think in a world where honestly also us venture capitalists have contributed to fast results being good results. Product-led growth is much more difficult to achieve and maintain.
All right. Well, that sounds to me like you're saying that actually sales and marketing does matter. It's just within the context of a good product, right? So I guess you have to have a decent product in order to be able to achieve some sort of market penetration, which I actually tend to agree with. I think my experience in working a lot with startup founders is that you often find those typical kind of tech-focused guys who get together and put together a really interesting platform or some sort of technical solution, and they've got this attitude of, well, if we build it, they will come. Which I think is true in Hollywood, maybe, but not necessarily in the real world. Do you have a view of that, of getting these type of startup founders to understand the importance of sales and marketing in building a successful business?
Absolutely, and I think you're completely right. I mean, I also I wanted to make it easy for you in the beginning, and
Well,
give you.
you're very kind. Thank you.
I'm a guest. I'm trying to be kind here.
Exactly.
But no, you're totally right. This is definitely an issue, especially with European founders. I might say even more so with CEE founders, at least from my experience, that they have the best product, but they just don't invest anything into marketing or sales. It's typically only the founder that goes out, and even the founder usually would love to spend the time on product rather than going out and talking to people and actually solving a real problem. Versus if you look at US companies, they most of the time have an inferior product. I mean, it's not true for all of them, but I've certainly made that experience in my own founder story. And I've made it a couple of times when funding companies that, usually they're just much better at sales and marketing. And you're probably the ratio between people that build product and people that sell product is just so different. So you're absolutely right. I think there's a big topic here.
Yeah, absolutely. And I agree with you on the gap between the kind of the US approach to building a business versus the European approach. There is certainly a more focused effort at developing a very clear value proposition and really packaging it in a really compelling way to build it. And in fact, I've experienced that as well, where sometimes the better mousetrap doesn't necessarily make a better business. It's just a better mousetrap. And so I think you have to kind of find that balance. But listen, let's not spend too much time arguing over that, because I think in generally we're in agreement that it's a balance of both. Let's go back to the start of Speedinvest back in 2011, which actually I was shocked to hear that you were only 10 years old, because considering the amount of success you've had as an organization, it's actually not that long of a time. What were the early days of Speedinvest like? How did you get started? What did you learn about building a successful global startup then that has stayed with you ever since?
So the early days of Speedinvest, and I have to say, for me, it's also surprising that it's 10 years already. So early days were really messy. I mean, we started, all of us as entrepreneurs, really. No one ever was investing into companies really, or had a background as a venture capitalist. So we did what entrepreneurs do. We kind of try to understand how others do it, try to understand the rules of the game. Got starting with very little. Our first fund was a 10 million fund. We're 6 partners. Everyone was telling us this is crazy. Like usually one partner would be able to invest that. But we had a very different approach to things. We thought, we would love to help the founders, help the companies go through the learning cycles a bit faster, and actually be there hands-on helping them. So if you want, we're trying to help others build companies, or build companies together with founders without having to do all of the heavy lifting ourselves. But that was very much what has driven us. And I think that has stayed true since then, and is true now. We're still trying to be, our investment team is 40 people for currently a 200 million fund, which is way too big by all means, by all standards of venture capital. But we just think we can only do what we want to do with that amount of people, being really close in seed, doing a lot of deals. So we very much stayed true to this original idea that we had, being early, being hands-on, investing much more than just money into the founders. I mean, in terms of learnings, you touched on one that I think is important, building a business versus building a product. And then also, I do have to say one of the learnings is that more money really isn't always better. And the more shiny the investor, that's not always better. It's hard to explain this to founders because, of course, how would you argue that? And there's so many cases where it actually worked out, but I have seen firsthand that very often, providing too much capital is just pulling the company into the wrong direction and taking that brand name investor that usually does Series A's, but then comes and does your seed round. Might work out, but actually most of the times doesn't work out.
And actually, I found that having too much capital on hand doesn't force you to find necessarily the most efficient solution to a problem, right? So if you can throw money at it, you kind of have the luxury of testing a lot of things and seeing what works, which obviously is part of the startup experience, but you can get into an extreme situation, right? Where you're, wasting money or burning money without really thinking through the options. Have you found in your portfolio that has been a problem, or do you think your founders have been good overseers of the capital that you've deployed for their business?
I think on average, I would say they were doing well with the capital available. And also, to be very frank, I mean, over the past decade, Europe still was underfunded compared to what the founders were doing, on average. But then you have these companies that, for whatever reason, end up being really good fundraisers or get a lot of money thrown at them. And then it's exactly what you said, too much money helps you mask issues that otherwise you would have to face. And it's not that, those are bad. It's just, it's in the nature of a startup that not everything can work out. So from my perspective, it's much better to see these issues clearly early on so you can work on fixing them rather than having tons of money that you can just throw at the problem and that way get along with it without having to act on them.
And have you seen the support that you provide your portfolio companies change over time? I mean, are you finding that you're spending, let's say, less time on basic fundamental go-to-market issues now than you did, let's say, 10 years ago?
Yes, we've seen that. I mean, the topics overall, to be honest, are still the same. It's finding great people, trying out growth and marketing strategies, and going through some difficult things like fundraising or building your equity story. But of course, founders and sort of the level of knowledge among founders in Europe has changed massively. We now very often have people that really understand what they're doing, that maybe have been through it a second time, and they know much better what they want. They still take these services and require these services. They're very happy about them, actually, but they're also much more demanding. So you cannot get away with the easy things. You really have to go in and work hard.
So the bar is higher. So actually, founders expect more from VC investors now than, let's say, they did 10 years ago.
Absolutely. And it's also, the market has shifted towards them. I remember when I was fundraising for my last company, it was really painful, and you could clearly see how this is an investor's market. And now that has shifted. The power is now clearly with the entrepreneurs.
Now, you are clearly now a pan-European investor if you think about all of the different countries and cities in which you're present physically. But originally being based in Vienna and growing from Vienna, did you have a focus on the emerging markets of Central and Eastern Europe to start and then grow into a pan-European business, or were you thinking pan-European from day one?
So we were thinking pan-European from day one, but we couldn't pull it off just based on resource constraints. So we had to stick, to what is close and what was possible. We also had this idea or the hypothesis that CEE is a great breeding ground for entrepreneurs. We, all the reasons that we just said, great tech talent, great people that we love to work with. To be very honest, in the first, I would say 5 to 6 years, we didn't really see that much out of CEE. And we were actually shifting our strategy to the usual hubs, trying to establish a presence there. I mean, we've still done consistently over every fund and every year, we've done a number of bets in CEE, but we haven't seen that pan out. You just didn't see the same results. And then, we're also results driven, so we had to change our strategy midway. but we are active, and we're coming back to it, and we're seeing some great companies being built. So I think some of the ideas or some of the hypotheses that we had back then are coming alive now.
Now, you have offices in Berlin, Munich, London, Paris, Vienna, and you have an arm in San Francisco, I guess, to tap into kind of the Silicon Valley ecosystem. How does having this many offices around Europe and a leg in the US help you in terms of sourcing deals, but also in terms of supporting your portfolio companies?
I think it's honestly the only way I would know how to do what we're trying to do. I mean, if you think about it, we're trying to do seed across Europe with a focus. Yes, we have 6 focused teams, so in the end, we end up being a generalist fund. But if you're not able to tap into the local networks in the earliest stages, like the business angels and the founders of other companies, you're never going to see the companies in Berlin or Munich that are being created, that are raising at the right time. You're always only going to see them once it's too late for you to actually invest, or you're only going to see them. You're only going to see the ones that you probably don't want to see as an investor. So I wouldn't know another way of doing this. I think you have to have feet on the ground and ears on the ground, especially in the most important ecosystems. And in terms of helping them, I mean, I think really there is no European startup ecosystem. It is much more a city-driven or location-driven ecosystem. You end up getting these groups of people, for example, in Berlin, that support each other very well. And you also get like thematic clusters based on the successes that are being produced. I mean, it's uncontested that London is the fintech capital of Europe. So if you want to do fintech, you probably have to be in London in one way or the other. But it's also, by being in London, you probably can support the companies much, much better with a local network, but with something beyond that. So that's why we're trying to do this.
And did having this sort of on the ground presence help you during the kind of COVID environment that developed, or didn't have a particular impact either one way or the other?
Didn't have an impact. I mean, like everyone, we switched to online, and every call you would ask the opposite, or the people you're talking to, where are you at the moment? So no.
But didn't COVID democratize the sourcing process though in some sense? I mean, in fact, didn't it make the local presence less important for the reason that you just described?
I think, of course, it's sort of you call it democratized. I would just say it increased competition to a crazy level, and it really turned the tide towards the entrepreneurs. We still, you're right, we still had some benefit of having feet on the ground because, for example, the first couple of deals that we did, I mean, it was a new situation for venture capital. In general, you couldn't meet people. So what we did in the first term sheets, we actually put a walk in the park clause into the term sheet. So one of our partners that was local had to take a walk in the park with the startup in order to
really
at least
That's
get a feel for the founders and see how the team behaves.
And was the length of the walk determined by the city it was in? I mean, Hyde Park is a big park, I guess, in London. That's be a long walk, or versus I don't know what other parks there are in the cities in which you were present.
Yeah, and the length of the walk also was, determined by are we going to invest or not. And
I see. So the longer the walk, the more I would imagine, the more information you were trying to gather to make a good decision. Okay, that's interesting. So you actually had that in your contracts or your term sheets.
We had that in the term
great.
sheets. Yeah, it was, of course, it was also a fun way to look at the new situation. But in the end, it's not. It's definitely not fun. It's about we're in a people's business. We're going to spend 5, 6, 8, 10 years with these people, trying to work through real issues while building a company. So you better want to get a feel for what those people, how they work, and how they operate. And hence, I think a lot has changed in the past 18 months. But still, it's the local networks. You're still working with people in your close vicinity that you maybe were an employee in a company before, and that usually has also some geographical aspect to it.
I mean, I have to say, I often tell the companies that I work with and advise that getting into bed with an investor it's like a marriage, right? I mean, you've got to be in a situation where you want to spend a lot of time with this person, and for that reason, that the personal connection is so critical. Which is, of course, is why the COVID impact on relationships and networking was so devastating for people in your business, because you couldn't have that personal connection. But it sounds to me like you found a clever route to at least get some benefit from those personal connections. So that's kudos to you for that. Let's shift gears a little bit and talk about some of your success stories, which is always fun to talk about for an Indian investor. Your portfolio consists of over 230 startups. This includes 4 unicorns, which I think is a really amazing ratio. You've had over 15 exits. If you think about those 4 companies, right? Unicorns being companies that are valued at $1 billion or more, which is increasingly becoming more common as valuations grow. Are there any common points you discovered among these 4 companies that may give us a clue about what it takes to build a startup that eventually becomes a unicorn?
Yeah, that's an interesting question because trying to do some pattern recognition. I mean, for me, first, it's interesting and also great to see that out of those 4 that are currently publicly unicorns, 2 of them are out of Austria, so out of our home turf, which again, stresses the point that you just made in terms of local networks.
Which is Bitpanda and GoStudent, yeah?
Exactly, Bitpanda and GoStudent. I think down the line we're gonna see our unicorns are gonna come from everywhere in Europe, but just also it's a factor of time. So these have been in the making for a while, and there's a good reason why we invested into them a while back. So these local networks played a pretty big role. So that's an interesting one. The other commonality, I think, is that 2 of them, WeFox and Bitpanda, are fintech companies essentially. So you also see that sort of the industry plays a pretty big role in whether your startup is going to reach that valuation, so the market size, really. But then I'd say it's also there are other commonalities that are maybe not so obvious. So just looking into Tier and WeFox, for example, these 2 serial founders, very execution driven in very tough industries, so insurance and mobility, that are really around execution. So I mean, Tier Mobility basically brought the scooter model, so the Bird or Lime scooter shared mobility model to Europe. They're now the uncontested leader. They're like in hundreds of cities or across Europe, so really doing well. But it's very clear this is an execution-driven model. It's not about the novelty of the idea. It's basically you have to take this idea and make it work in a market like Europe, which is completely different than the US. Or insurance, WeFox really sort of it's a basic insurance model, right? There's not much there's not radical innovation going on here, but you really need to know what you're doing. So so the serial founders taking on those execution heavy models, while on the other side, you have Bitpanda and GoStudent, both of them bringing a fair amount of innovation to the market. So GoStudent being an online learning platform, like a marketplace between tutors. Yes, there have been these kind of models before, but every market is different. The demand is different. It's not varsity tutors. It's sort of much more early. And you have to work through that model. They went through a lot of iterations, and quite frankly, there were times when GoStudent was close to bankruptcy and didn't know how to raise more money. I think same with Bitpanda. Very new market. There were a lot of exchanges out there. A lot of people tried to do the same thing. And for both, you could actually say, so why should any of these companies come out of Austria? And there's my take on it. I think that's with new models where it's less about execution. I mean, execution is always important, but it's more about making that model work and scaling it. That really can come from anywhere because it doesn't matter where this model comes from. There's no benefit or no advantage starting it from a certain place. It is really whether you can figure it out fast enough and then raise capital. And so they have very different histories in terms of what type of businesses they are.
So that's interesting. So what I'm drawing from that is that when there's startups that are entering markets where there's heavy competition, the importance of execution grows because you're not bringing in some radical innovation as you described, but you're actually just doing something better. Versus if you're going into markets where you have high levels of innovation, there the ability to test and react and iterate and come up with the right mix of business model and go to market strategy is what's going to really be driving success. Is that a fair conclusion?
Absolutely, and maybe adding to the point that we touched already, both GoStudent and Bitpanda had times in their company history where they really had trouble fundraising. So from day one, they needed to find a model that really works for the clients and gives them business growth. So that was a very different approach versus, I mean, that scooters work, right? The question is just, can you get them into enough cities fast enough, right?
We've talked about the big wins, right, or the big breakthroughs. None of which have actually reached exit stage, I believe. Right, you haven't exited any of these companies.
No.
Which of your exits is memorable? Which one is that really sticks out in your mind for whatever reason?
All of them are memorable in some way, but
Well, you love all of your children the same, but really, there's one that you love the most. No,
that's true. No, again, I mean, in a history of also personal history of venture capital, there's some exits that are more meaningful than others. I think the one of Spock was one that was very memorable to us because it was our first sort of major exit. It's
also an Austrian team, I believe.
Also an Austrian team, and they were basically doing eBay on the mobile phone. And that was sort of the first moment that we thought, this can actually work,
This actually could work.
Yes,
okay,
it's also the moment where you go home to your spouse or your mom and you say like, look, mom, it's gonna work, right? Because up until then they were all like,
it was worth giving up my high paying job and my all the benefits just to start with something, start something from nothing and hoping it comes together.
Yeah.
So good. Okay, so that's a great one. And when was that exit?
That was early on, I think. Wait a second, was it 2014, 2015, something like that? I mean,
okay, so about 4 or 5 years into your
yeah. It took a while, and venture capital is a long game, right? But we sold parts of our share, and that's maybe something that is also memorable and interesting to me. So we sold parts of our share actually when they raised a round as secondary, and then when the final exit came, we got the rest of it, and that tiny rest, the tiny remainder that we kept in shares, in the end was worth more than the initial part that we sold. So it's also always good to hold on. This is just the law of venture capital.
Absolutely. And what would have happened if you have held on to those shares?
Yeah.
Huh? Did you do the math?
Of course we did the math. Good thing is we didn't have a choice back then. So it was
right,
all good.
Right. So one of the consistent feedbacks I get from all of the conversations I have with every single investor is that at the end of the day, sure, market's important and product's important and go to the market and all that stuff is important. But effectively what we're doing is we're investing in teams. We're investing in people. Now, I found a quote from you, and you said, good teams are like a band. Together they sound better, and when you are on stage, it feels like magic. Good teams get the best sound possible and are obsessed with creating wonderful music for their audience. So, tell us about the teams that built these future unicorns. Did they always play beautiful music together?
You did your research. That's a good one. So I have to say, and that's probably also ties back into your first question. I'm not in the people camp alone. I think if you ask any venture capitalist out there, would you invest into a great team that has a shitty product or is in a market that you just don't believe in? Nobody would do that. You have to have the package, right? And that's the same thing with the Beatles are the Beatles because they have a couple of things going for them. They're not only a great band, but they also write great music and they know how to perform. So there's a lot of things. Now, did those teams in those four especially, did they always play well together? To a large extent, yes. But I have to say also, again, comparing, if you look at, GoStudent, the founders, and Bitpanda, the founders, they're really much more like a band of brothers. And they went through a lot together. So they stick together versus in...
So they got into fights on the lawn in the afternoons or what?
Everyone has different strategies. But yeah, they're very close-knit. They're very tight-knit. And then, you look at WeFox or Tier, both of them serial founders, they really, they built a management team very early on. They pulled in heavyweights that are really good in executing in that industry, and they bring stuff to the table that is important in what they're trying to achieve. So, very different approaches. But in the end, I'd say, they're all great teams. Yeah.
And what do you think the investor's role is in managing startup teams? I mean, what do you do when the band comes together and they just play really poor music? Do you go in there and tell them, guys, you got to do better, or you got to get rid of the drummer because he's just not keeping the beat?
I think you're basically like a good producer, right? you're trying to strike a balance between being brutally honest and giving them time to figure it out themselves. Because, I mean, there's no kidding. Everyone knows if someone plays the wrong tune in a band. Like, it's not that you're not listening to it. You're just, sometimes you're just trying to find out how to tell it to that person. Sometimes you're just, giving people a bit of time to figure out their what they're playing. But I think it's a very delicate balance between being some sort of a coach, a producer that really clearly also provides feedback, and then at some points really being like a tough manager, in a sense of also making it clear when things need to change. Yeah.
Got it. Okay. So ultimately being a good investor means being a good producer as well in some capacity. You can say that. So as we move towards the end of our discussion today, I wanted to get your feedback on something in particular that struck me from some of the research we did in preparation for today's conversation. A popular narrative among entrepreneurs is that investors are focused on maximizing shareholder value, squeezing every last bit of value out of founders for their own benefit. Not a very flattering picture. But I have spoken to enough founders who are really fearful of bringing investors into the company because, of what they're going to do with their company. And I was struck by a sentiment you wrote in your bio about how you believe that investors can actually make a dent or a positive impact in the universe through their work. And can you talk about what that dent is exactly and how it impacts your approach to investing?
On the first part that you said, I think that's one of the true misconceptions out there, that of course, there are ruthless investors. I mean, I've seen it firsthand. I've seen how investors try to push out founders. But if you're really honest, we're owning a minority of the company. We're not driving it ourselves. We essentially invested into the team, and that was our bet. And we have all the incentive in the world to actually, back the team. And by backing, I really mean that in a literal sense, to have the back of the team. So there's really very little situations where something like this actually happens or is in order. And I do think in the end, it's like you said, it's people's game or people's business. I personally, I'm certainly in it for sort of the human connection and seeing founders grow and just solve something that they're passionate about. That's all I get out of this.
And that's your role, right? To help these entrepreneurs bring their dreams to life in some capacity.
Absolutely, and also if you look at it, there's a big discussion maybe only among VCs. Who's the client of a venture fund? And I'm firmly believing the startup is the client. We need to do something that founders like, because as much as it's important that we have money from investors, from LPs that back us, that we can then invest into startups. The only thing that we give them and we promise them is actually some return. But you need to be able to work with the best teams out there, and you need to be able to find that chemistry so that it works. So I think for me, it's really about that human connection, and that it not only creates sort of companies that are successful, doesn't only create stock value or returns to LPs, but it also creates personal stories, personal growth stories, and those are where the real magic happens, where you really see that people get to do stuff that they love in an intellectually challenging environment, very often bringing something to the world that makes the world a tiny bit better. That's a combination, you're basically creating a positive impact on so many levels. And that's what I'm passionate about.
Thank you, Michael. On that positive note, I want to thank you for joining me here today on Launch Stories. And I want to thank everybody out there who listened to this episode of the Global Startup Podcast. Really hope you got inspired again from some of Michael's words and learned some of the ingredients of building a successful global business. If you like what you heard, please subscribe, leave a review, and share it with your friends.